I want you to notice something about the way that headline was written, because the people who wrote it were counting on you to feel a particular thing. A group of officials inside the Federal Reserve wanted to raise interest rates. They did not get their way, but they made themselves heard, loudly, and the financial press turned it into a warning shot aimed straight at anyone who owns gold. The message underneath the message was simple: be afraid. The tightening is coming back. Sell now while you still can. And if you are a retiree, if you have spent a working lifetime building up a nest egg, and you have finally put some of it into something real, something you can hold, that headline was designed to make your stomach drop. So before you do anything you might regret, before you let a divided vote and a nervous anchor talk you out of a position you thought hard about, give me the next 20 minutes. Because there is one thing, and really only one thing, that has ever truly broken gold in the modern era. And a hawkish vote by itself is not it. Here is the fact I want you to sit with early, because it reframes everything that headline was trying to do to you. Gold does not fear the Federal Reserve. Gold fears exactly one weapon in the Federal Reserve's hands, and it is a very specific one. It is not a rate hike. It is not tough talk. It is a bond, a plain government bond that pays you a real return after inflation. That is the metal's only true enemy. When a saver can lend money to the government and get paid back with more purchasing power than they started with, gold has to compete with that, and gold pays no interest at all. That is the whole contest. And the last time the Fed truly won it, they had to do something that I am not sure this country could survive today. Let me take you back, because this is not theory. This actually happened, and the man who did it has a name. At the end of the 1970s, gold was on a tear that had lasted most of the decade. When the United States cut the dollar's last link to gold at the start of that decade, the metal had been legally pinned at a low fixed price for a generation. Once it was set free, it ran. Over the 1970s, it climbed from that old fixed level to over $800 an ounce by the very beginning of 1980. Inflation was eating the country alive. People had lost faith that the paper in their wallet would hold its value, and they were right to. Gold was not a speculation in those years. It was a verdict on the men running the money. The Fed chairman before the big turn had flinched. He faced an oil shock and a slowing economy, and rather than break the fever, he let inflation run. That is what a central bank usually does, because the medicine is brutal and nobody wants to be the one who administers it. And then a very tall, very stubborn man took the chair, and he decided he was willing to be hated. His name was Paul Volcker. And what he did was take interest rates up into the high teens. Think about that. He made the cost of borrowing money so punishing that he deliberately drove the economy into a deep recession. Farmers drove their tractors to Washington and blockaded the building. Home builders mailed him blocks of wood because nobody could afford a mortgage and the industry was dying. He was, for a stretch, one of the most unpopular men in the country. But he had made a decision. He was going to make holding dollars pay, really pay, more than inflation, no matter what it cost. And it worked. He broke the back of inflation, and in doing so, he broke gold. Gold peaked near $850 at the start of 1980, and then it began a decline and a long, grinding, sideways exile that lasted the better part of 2 decades. 2 decades! A whole generation of savers were taught by that experience that gold was a relic, a barbarous leftover, an asset for cranks and people waiting for the end of the world. And do you know why they were taught that? Because for 20 years, you could get paid a fat, real, after-inflation return just by owning a government bond and doing nothing. When the risk-free money pays you handsomely to wait, why would you hold a lump of metal that pays you nothing? That is not sentiment. That is arithmetic. Volcker won the argument with arithmetic. Now, I want you to hold that story in your mind, because the financial media wants you to believe we are back at that moment. A few officials voted to hike. The chair, Kevin Warsh, has made it clear he will not tolerate inflation drifting higher. And so the implied threat is, here comes Volcker again. Here comes the 2-decade exile. Get out of gold before the hammer falls. That is the fear they are selling you. And here is why it is, I believe, a hollow threat, and why the smart money is not buying it. Before I get into why the hammer may never come down, I need to stop for a moment, because this is exactly the point in the story where a retiree is most exposed, and I would not be doing my job if I let it slide past you. If you are sitting on $100,000 or more in a retirement account, and a headline like this one has you wondering whether you should be protecting some of what you built, I want you to know something that the big banks are not eager to explain. The largest, most sophisticated buyers of gold on the entire planet right now are not private speculators. They are central banks. The very institutions that print the currencies have been quietly buying physical gold at a record pace, year after year. And they are doing it above $4,000 an ounce. Because for them, the point was never the daily price. The point is to own something that no other country can freeze or inflate away. And here is what almost nobody tells the ordinary saver. There is a perfectly legal, completely established way for you to do the very same thing inside the retirement account you already have. You can move a portion of an existing 401k or IRA into physical gold and silver, held for you, without triggering taxes and without triggering penalties, through what is called a self-directed precious metals IRA. This is not some exotic loophole for insiders. If you have $100,000 or more in any retirement account, this is available to you. We put together a free guide that walks through exactly how it works. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. There is no cost and no obligation. Now, let me get back to why I think that Volcker hammer stays in the drawer. Here is the difference between Volcker's world and ours, and it is the single most important thing in this entire video: debt. When Volcker took rates into the high teens, the United States government owed a relatively modest amount compared to the size of its economy. The government could afford to let interest rates go to the moon because the interest bill on the national debt, while painful, was survivable. The country could take the medicine. Today, the picture is unrecognizable. The national debt is many, many times larger relative to the economy, and the amount the government spends every year just to pay interest on what it already owes has climbed to levels not seen in generations. It is now one of the largest single line items in the entire federal budget. So ask yourself the question the trading desks do not want you to ask out loud. What happens if a modern chairman tries to do what Volcker did? If the Fed took rates up into the high teens today, the interest cost on the national debt would not be painful. It would be catastrophic. The government would find itself borrowing new money simply to pay the interest on the old money, and then borrowing again to pay the interest on that, a spiral that feeds itself and accelerates. Every point higher on rates would add another crushing weight to a budget that is already straining. Volcker had room to swing the hammer because the government behind him could still absorb the blow. A modern chairman swinging that same hammer would shatter the very floor he was standing on. This is a trap that has a name among economists. It is called fiscal dominance, and it means the central bank loses its freedom. It can no longer set rates purely to fight inflation, because doing so would blow up the government's own finances. And this is not hypothetical either. There was a time in this country, before a famous agreement between the Treasury and the Fed at the start of the 1950s, when the Fed was not independent at all. It was ordered to hold government borrowing costs down, to keep the government solvent for about a decade. The inflation that resulted was simply eaten by the savers. The Fed was a tool of the Treasury, and there are people who understand the math who quietly believe we are drifting back toward exactly that arrangement. So when a handful of officials vote to hike and the chairman talks tough, I do not hear a threat to gold. I hear a group of honest people staring at an inflation problem, wanting to reach for the Volcker cure, and being unable to fully use it because the debt will not allow it. They can raise rates a little. They can talk a great deal, but they cannot take rates to the level that would actually pay you a rich, real return for 20 years because the government cannot afford the bill. And a bond that pays a real return is the only thing that has ever truly beaten gold. If they cannot deliver that weapon, they cannot deliver the exile. Let me put a face on this, because numbers alone do not move anybody. Picture a saver in 1980, a machinist, let us say, who had watched inflation gut his paycheck for years and had finally moved a chunk of his savings into gold near the top. He held it and he watched it drift, and every year the man on the television told him he was a fool, that bonds were paying beautifully and his metal just sat there. For 20 years he felt like the town crank. That man was punished, and he was punished by one specific thing, a real yield he could have had instead. That is the true cautionary tale. Now picture his grandchild today, wondering the same thing, staring at the same kind of headline. The difference is that the weapon that punished the grandfather cannot be fully loaded anymore. The gun is there. The bullet is too expensive to fire. And this is why you are seeing something on the charts that is not supposed to happen. For most of modern financial history, there was an iron rule. When real yields rose, gold fell. They moved as opposites, like two ends of a seesaw. That relationship was so reliable that the trading desks built their models on it. And recently, that rule broke. Gold has climbed, even as real yields have stayed high. The seesaw stopped working. And when a rule that reliable breaks, it is not noise. It is a signal that the market has begun to price in something deeper, something structural. The possibility that this time the Fed does not get to finish the job, that the debt has changed the game. The desks that built their models on the old rule are the ones most desperate for you not to notice it is broken, because their whole story about why you should not own gold depended on that seesaw holding. It is not holding anymore, and they know it, and the quiet way they have stopped mentioning it tells you everything. Now, I promised I would not sell you a fairy tale, and I am not going to. So let me be honest with you about the risks, because the people who only tell you the bullish half are not your friends either. Gold can fall, and it can fall hard, even inside a long rise. This is not a straight line. In the middle of its great run in the 1970s, gold nearly cut in half, dropping from around $200 down toward $100 before it turned and multiplied many times over into its peak. Anybody who panicked in that valley sold near the exact bottom. It happens with silver too. There is nothing that says a divided Fed and a hawkish speech cannot spook the market into a sharp drop next month. I cannot promise you a price, and I cannot promise you a date, and anyone who does is lying to you. This is a case built on history and arithmetic, not a guarantee, and it is not personal financial advice. But that is exactly why the how of owning it matters as much as the whether. If you are going to own gold, own the real thing, the physical metal, not a paper claim that some institution can suspend or settle in cash when it matters most. And size your position so that a shakeout, a scary month, a hawkish headline can never force you to sell. The person who gets hurt is not the one who owns gold. It is the one who owns too much of it on borrowed conviction and gets shaken out at the bottom by a headline written to shake them out. Own it so that you can hold it through the noise. That is the whole discipline. And here is the part one most want you to hear, because it is the part the financial channels will never frame for you honestly. You are early. That is not flattery. It is a description of where we are in the cycle. The central banks already know. They accelerated their gold buying after they watched one major country's foreign reserves get frozen overnight, because they learned in that instant that reserves held in someone else's system can be switched off, and gold sitting in your own vault cannot. Gold has already quietly overtaken the euro to become the second largest reserve asset held by central banks on Earth, behind only the dollar. The smart money has already moved, but the pension funds have not. The financial media has not. Your neighbor has not. The mainstream still treats gold as a curiosity, the way that machinist's neighbors treated him in 1980, except this time the story is running the other direction. And by the time it becomes obvious, by the time it leads every news segment and every advisor at every firm is suddenly recommending it, the easy part will already be behind us. That is how it always works. Nobody is going to call you at home and tell you the window is open. Nobody sends you an invitation to be early. Being early feels uncomfortable and uncertain and lonely, precisely because the crowd has not arrived yet to reassure you. The moment it feels safe and obvious is the moment the advantage is gone. So let me answer the question in that headline directly, the way I promised I would. 3 Fed officials voted to hike rates. Should that scare you out of gold? No. And now you understand why. A hike is not the weapon that has ever broken gold. The weapon is a bond that pays a real return for years. And the mountain of debt this country now carries is the very thing standing between the Fed and that weapon. The Hawks can vote, and Kevin Warsh can warn. But the arithmetic that let Paul Volcker win in 1980 is the arithmetic that will not let his successors repeat it. The threat in that headline is the sound of a trap the Fed cannot fully spring. If you watch this all the way through, you are exactly the kind of person this next part is for. For viewers with $100,000 or more in a 401k or an IRA, we hold a free one-on-one educational web conference. It is not a sales pitch, and there is nothing to buy on a call. It's a chance to sit down with someone who does this every day and ask your own questions about how a portion of your retirement savings could be protected with physical metal and whether it even makes sense for your situation. And the honest reason to do it now is not fear. It is the opposite. The best time to think clearly about a decision like this is precisely when nothing feels urgent, when you are calm and there is no crisis forcing your hand, because that is when you make good decisions instead of panicked ones. Right now, with the crowd still asleep, is that window. If you are watching on your television, scan the QR code on your screen and mention that you watch this to the end. If you are on your phone or your computer, go to jeffreyguy.com. Come with your questions. That machinist in 1980 was punished by something real, a yield he could have had instead of his metal. His grandchildren are being threatened with the same punishment by the same headlines. But the gun that fired in 1980 is loaded with a bullet the country can no longer afford to fire. Understand that, and a scary headline about 3 votes to hike becomes what it actually is. Not a warning to sell, a tale about so little room the men in the room really had.